So much for China's new policy on the yuan. While the currency has moved since it was officially depegged from the dollar about 10 days ago, economist Erik Schatzker calls it a sideshow to the real story in China, one that could have far bigger implications for economic growth, world trade, and possibly the stock market. Andy, a Bloomberg guest columnist, is Morgan Stanley's former chief economist for the Asia-Pacific region. He also spent 5 years as an economist at the World Bank. Andy is with us on the phone from Shanghai. Andy, so let's start with this. What is the real story if it is not the currency?
Well, I think that China's surplus labor has been exhausted. The story about China in the past 20 years has been about this endless supply of labor and things getting cheap. Now we have gone through the tipping point. I think that the wages are really going up, and that's going to boost consumption and help to rebalance the economy.
Okay, so wage inflation at the tipping point going to have big implications for the economy. What ultimately does it mean for the Chinese economy if you do have Chinese laborers, people in factories, all of a sudden under pressure, or at least clamoring for greater wages? We've seen suicides at Foxconn. We've seen these strikes at Honda and Toyota. How does it play out in the bigger picture?
Well, I think that the economy will slow. China was growing at a double-digit rate before, but in the future will be like between 6 to 8%, and the inflation will be high. It was very low. And in the future, we could have seen double-digit inflation rate for a period of time. So I think that that's sort of something that China is not. The world is not used to China being as the source of the inflation, and not like the source of deflation as before. So I think that it will have a big impact on the global economy.
Okay, but if you see these inflationary pressures in China, Andy, I'm assuming that the central bank will at some point be forced to act. It has been very reluctant to raise interest rates. But if, in fact, it does have to act and does raise interest rates, what's that going to mean, say, for the Chinese stock market, which is already down some 25, 26% this year?
Yeah, I think that the government doesn't know what to do, but they don't want to raise interest rates because a lot of people have debts. But the problem is that inflation is going to be high. You have to raise interest rate now. But the delay is not having the desired effect. The market is expecting interest rate to go up. So the stock market is feeling the pain first. I think that the property market is going to be the next. Maybe it may take another year or so to feel the impact. Even though the government is delaying the decision, I think the market is reacting. So no matter what, China will see interest rate going up, and the asset prices will come under pressure.
All right, that is Erik Schatzker, former Morgan Stanley chief economist for the Asia-Pacific region.